Welcome back to International Finance. I am Andy Kim, your Dr. Finance. This is Chapter 5 of Un, Resnick, and Chul Loon, the second part of my lecture. And we start with the discussion of correspondent banking. And in my first year of Bank of America Seoul branch, my job was to support the relationship manager at correspondent banking. Okay. What is this correspondent banking about? At first, they said co-bank, right? Co-bank. What the heck is co-bank? Is it like co-knows, right? No, it's not. It is about correspondent, which is like 특파원 in Korean terminology, or 원거리 거래처에. Like this Bank of America, when they're working in Korea, they have to do a lot of FX transactions with major banks, as in wholesale market. For example, 기업은행, IBK, or Bank of the Korea Development Bank, or 국민bank, kind of major banks, right? So for our FX traders on the trading desk to be able to trade with them, we have to set up our relationship first, okay? And it's not going to be just transacting once per quarter or something. They have to trade like every day or every week, right? For that purpose, we set up this something called correspondent banking relations, which is we are keeping mutually we are keeping each other's money in our deposit account in our balance sheet, okay? And then the balance sheet, the deposit comes as a liabilities for bank's perspective, because demand deposit, you have to give it to the deposit owner or the original money giver whenever he or the banks ask for it. That's a liability. And then the matching principle tells us that there has to be some matching amount in our asset side of it. So mutually we are keeping each other's deposit amount, right? In respective currencies like US dollars, right? Or Korean won, kind of things. And then my job as a credit analyst was to assess the credit worthiness of these major banks, right? Right after financial crisis, the concern was these banks may suffer from big loan loss. So what are their proportion of non-performing loans, bad assets, right? What's the chance that they may hit another banking crisis, or like financial trouble like that? And socially, my work was supporting my RM, the relationship managers. The relationship managers, they talk to these clients, the other bank guys over there, and then they eat dinner together and go for drinking party together, sometimes or golfing together, like, yeah. And then before they go to those kind of meetings, they have to have some credit reports from me, right? How these guys are doing. So that's correspondent banking relations. Here's an example, okay? Not about the drinking part, but about the bookkeeping part. We are a serious business, by the way. And then Bank A is in London, Bank B is in New York. Right, transatlantic relation, okay. The current exchange rate is 1.25 US dollar per British pound. The currency trader employed at Bank A buys 160 million pounds from a currency trader at Bank B for 200 million US dollars settled using its correspondent banking relations. So the money goes from here to there and there to there, right? So they're exchanging these two currencies at the market rate, okay? Now, yeah, map works like this, east and west, right? Now, how do they keep this transaction in their books, right? Bank A, their balance sheet looks like this. Bank A in London, in million units, right? Assets and liabilities, debit and credit, right? 차변, 대변, like ding, T account, right? So old and new are shown respectively, old and new, okay? Before transaction, after transaction, like this. So Bank A, okay? got their British pound 160. So the British pound account, okay, this is their British pound deposit at Bank B. I keep my deposit over there. That's my asset, okay? And then that's their liabilities. This one will show up in their liabilities, right? Now, my asset used to be 300 pounds, right? But with this transaction, that deposit amount increases by 160 pounds over here. Make sense? Increased. So that means this money actually did not cross over this Atlantic Ocean, but it's just there, right? In their region, in their New York City, okay? Why do we do that? Because this transaction is taking place so much frequently, we don't necessarily require this money to be crossing over to our country and then just I have to use it. No, I don't mean that, right? We are just transacting US dollars and then British pound for our FX risk management purpose, okay? Now, 160 million British pounds increased. In response, my deposit amount at Bank B should get reduced by 200 million US dollars. That's what's happening over here, okay? And then the other amounts in my balance sheet as Bank A, right, does not change. They don't change. And then if you add these numbers, you will see that total amount, right, does not get changed. Now you will just have to convert this US dollar amount into British pound and you will get this answer. Now, if you look at the liability side of Bank A, right? Bank A, we are talking about this guy in London. They keep Bank B's deposit in respective currencies, US dollar and then British pound. And guess what? The Bank B's US dollar amount should increase because they're taking 200 million US dollars from us. And then their British pound deposit amount should go down by 200 million British pounds because we are taking that, okay? So this change happens, the rest of the amount does not change. All in all, nothing changes in aggregate, okay? Right, and then the next page you will see Bank B's balance sheet, okay? Bank B in New York City, and they have also assets and liabilities and equity also, but don't touch it. Now, assets, what do they have? Well, Bank B's deposit at Bank A, right? I put my money over there, right? That's my asset. And that's this guy. And then this should increase by 200 million US dollars because Bank B is taking $200 million from Bank A, and in exchange for 160 million British pounds. So their British pounds balance will decrease by 160 million, and the US dollar deposit will increase by 200 million dollars, right? The remaining accounts, they don't change. All in all, this total asset amount, okay, hypothetical asset amount does not get changed, okay? Again, this correspondent banking relation, the balance sheet, nothing happens in aggregate, okay? They are not taking away the money from one country to the other country, but they're keeping their balance as a patrons of mutually patron relations, right? Frequently transacting with each other. So let's keep their balance with the deposit amount for in mutual bank's balance sheet and then adjusting it accordingly inside those, right? And then Bank A's pound deposit, okay, increased by 160 million pound, and then Bank A's dollar deposit gets decreased by 200 million. Their, matching principle happens over here. All right. Now that's correspondent banking relations kept in balance sheet, right? Right. And then there's another problem that you can do as a practice problem. Bank X is in Milan, Bank Y is in London. The current exchange rate is 1.1 euro per British pound. On the next slide, show the correct balances in each account if a currency trader employed at Bank X buys 100 million pounds for a currency trader at Bank Y for 110 million euros, right? Like this. So do your numbers and then see what happens over there, okay? In your free time. All right, I hope you did your numbers correctly, and I'm going to give you that answers later, all right? Correspondent banking communications. Well, these wholesale level banks, right? Because they are frequently transacting in the global level, right? They have special the codes like the followings. The international commercial banks communicate with one another using something called a SWIFT. Actually, what I've seen in the industry is like SWFT, right? Without I, it's not Taylor Swift, but the society. It stands for the Society for Worldwide Interbank Financial Telecommunications. So whenever you, as a retail client, right, you want to send your money from Korea to maybe Germany, or from US to Canada, or maybe from the Singapore to France, right? The bankers on the counter ask you, what is the SWIFT code of the correspondent banking that will receive your money on the other side of the transaction? So if I want to send my money from Korea to a US bank account, I have to tell the SWIFT code of that US bank to my Korean bank, my teller over here, so that they will punch in the SWIFT code of this US bank, so that they will be safely sending my money to the US, right? So that's a ID number. The way I understand it is ID number of each different banks, right? And then CHIPS is another thing. Clearinghouse Interbank Payment System, and an Echo Exchange Clearinghouse Limited, the first global clearinghouse for settling interbank FX transactions. So market clearing happens through this system. Okay, what you have to remember for your daily lives is SWIFT code, right? And then spot market is the next thing. Okay, we want to cover. But before that, right, those SWIFT or correspondent banking relation, all these kind of things. Well, if you think about this diagram over here, there is a 1, 2, 3, 4, and 5 places where this transaction fees can be charged. When you are, first of all, converting your money from one currency to the next in this bank. And then the other is when the recipient is changing their currency from the currency to the other currency over here. The converting transaction fee has to be charged. And then among these wholesale banking relations, they have to charge the fees for, first of all, sending their currency to the other side from respective side of the transaction. And then they have to charge the, interbank, the clearinghouse. They have to charge your fees. 5 different places. I don't want you to remember all these 5 places, but remember they are charging you a lot of fees during these transactions from one country to the other countries, right? One of the ideas of Bitcoin or this cryptocurrency idea was like, well, why do we need all these kind of banks getting in there? And then the bankers association kind of, interbank relations, do we have to depend on this, right? They seem to be like a fat cats, and then they are doing, inefficient business. It takes about 2 to 3 business days. You have to wait, and then you have to pay a lot of fees for that. why don't we simplify those relation and then replace this currency with something called Bitcoin, so that you just forget about all these and then you convert your currency into Bitcoin, dollar into Bitcoin, and then the other side of the globe, you convert back that Bitcoin into your own currency. So a transaction fee you have to pay for only two places over here. And then that kind of conversion can take place in a single day. Okay, why don't we make it more efficient? And then previously it was more centralized in the sense that the whole thing was controlled by these bankers, right? There was, each government was, how do you say, giving the charters so that they will do their own business monopolistically almost. Whereas Bitcoin, you are doing it in a decentralized way because you don't need banks, and then respective guys, they keep their ledgers separately, open ledger and then shared ledgers, okay, in their servers, right? So that's the idea of cryptocurrencies and Bitcoins. And then keeping the blockchain as a building block for this kind of technology, right? That's the idea of this cryptocurrencies. And anyway, so just to keep in mind about this, what is going on. Now let's move down to the spot market, okay? The spot market involves almost immediate purchase or sale of foreign exchange. So you're caught on the spot. 현행범 kind of 현장에서, right? 걸렸어요. It's like a anyway. So one can buy long position or sell short position, foreign exchange. Cash settlement is made in 2 business days, right? Just like your stock transaction, buy, sell, 2 business days, you get the cash, or cash has to go. The banknote market for converting small amount of FX, which travelers are familiar with, is different from the spot. Not a sport, it's a spot. Sorry, spot market we discussed here. According to BIS statistics, spot foreign exchange trading accounted for 32% of FX trades in 2019. So the next chart table shows you that number over here, right? 32%. Spot, outright forward, foreign exchange swaps, all these kind of things. Just take a look at it. All in US $1 billion unit. Anyway, then spot rate quotations. Well, you have 2 different kinds of quotations that can confuse you awfully. Okay, direct quotation versus indirect quotation from the perspective of the currency that you are interested in. Usually in this textbook, it's US centric textbook. So remember, this is the professors from Georgia Tech. So their perspective has to be US centric, right? US perspective, direct quotation, 1 unit of your currency is how much in my currency unit, in US dollar, they say, right? The US dollar equivalent, e.g., a Japanese yen is worth about a penny. That's a cent or something. Okay. Number 2 bullet point is that the indirect quotation from the US perspective. Indirect from US perspective. That is the flip or the reciprocal of the former. Okay? 역수. 1 unit of my currency or US dollar is how much in your currency unit. Okay? The price of a US dollar in the foreign currency that you will look at. For example, you get 100 yen to get $1, right? $1. I should have said 1 over here. A dollar. Exhibit 5.7 in the textbook shows that, right? That's this guy. Holy cow. What is this? This is exchange rates as of April 3rd, 2019. right? About 2 years ago. Now, you see US dollar, right? Foreign exchange rates in late New York trading Wednesday. Okay, Wednesday. And then the country / currency, you can see it in US dollars, right? And then per US dollars. So, this is direct quotation, and that is indirect quotation. I should say it over here. Direct quotation, indirect quotation. Okay? Now, here again, direct, indirect. And what kind of currencies do we see over here? Where is South Korea? Yeah, there you are, over there, right? The first thing that I try to see. And all of you may try to find your own currency down there, right? Good, right? All right. So, countries. America comes first. America first. Donald Trump. All right. And then you see Argentina, Brazil, Canada, and then all these South American countries. And then comes Asia Pacific, Australian dollars and Chinese yuan, Hong Kong dollars, and then Indian rupee, Indonesia, rupiah, okay? And then Japanese yen, Korean won, Sing dollar, Malaysia ringgit, New Zealand, Pakistani, and yeah, Taiwanese dollars. And then on the other side, you see European countries, and then Middle Eastern countries and African countries down there. Okay? Now in Europe, you see Euro area zone, but not all countries in Europe use Euro, right? Czech Republic, Corona, is that like Corona? No. Okay. That's crown. Denmark, and then Hungary, and then all these Switzerland, Swiss franc is still there, and the UK, British pound is still here. Okay. Not just still, it is Brexit. So what am I talking about here? Yeah. And then, the Middle Eastern countries, yes, you see those, right? And then let's move down to the next slide. So direct and indirect quotations as of April 3rd, 2019, you see US dollars, right, versus euro and British pound, right? If you check these numbers, they will be identical. That I got it from my daddy. Daddy. Yes. Here we are. Okay. Those numbers, I got it. And then took down over here. Okay. And then you see spot rate over here. And then something called forward rate for euro currency. And for British pound again, the spot rate and then forward rate like this. Okay. This tells us, right? This tells us that the exchange between US dollars and these two currencies are very intensively done, right? The big market is there. Forward rate is a big information, right? Other currencies, you only have these spot rate numbers in this chart, but these two or other markets with the forward rates available, this represents that there is an intensive market activities going on. Japanese yen, and then Australian dollars, and all things like that, right? 1 month, 3 months, 6 months forward. We're going to talk about that forward concept later on, so wait for that. And then US to euro, right? So this tells us that 1 euro is worth 1.1233 US dollars right now, okay, as of that day, right? If you take the reciprocal of it, it will tell you that 1 US dollar is worth 0.8903 euro, okay? And then British pound, right, at that day, 1 pound was worth 1.3158 US dollars. And you take the reciprocal of it, you'll get 0.76 British pounds per US dollars, right? In British pound used to be like 2 to 1, 2 US dollars per British pound, right? but the British pound value decreased over time substantially. And euro as well, right? Strong dollar, that's the phenomena, all right? And then the direct spot quote, right, for the pound, and indirect spot quote, you see that, right? Direct, where is that? Direct, and then indirect, that's, come on, this guy, right? From the US perspective. Now, let's move down to, yeah, note that the direct quote is a reciprocal of the indirect quote. Yeah, as you see it. Now, here is one interesting table called, I know your eyesight goes to the left-hand side, the rosé of Blackpink, but wait for that. Here, what you see is a cross-currency table, okay, cross-currency rates table. What do you see? Well, 11 different countries. US currencies are here. US dollar, euro, Japanese yen, British pound, Swiss franc, and then Canadian dollars and Australian dollars, and New Zealand dollars and Hong Kong dollars. And this is not North Korean won, it's Norwegian krona. And then this is Swedish krona. Okay. And then this is like, cross-currency exchange rate. So Swedish krona, Norwegian krone, and then Hong Kong dollars, right? Things like that. Use the same currency on the vertical axis, just like in the horizontal axis, right? So for US dollar is 1-to-1 relation, so no need to show it, just omit it. Euro to euro, nothing is interesting, just delete everything in the diagonal, right? Way. And then it shows that for currency over here, 1 US dollar is worth 111. I should change my color into red, all right? Red, 111.49 Japanese yen for 1 US dollars, right? And 1 US dollar is worth 0.75997 British pound, right? So this is indirect quote from US dollars perspective. You see it, right? And then you see direct quotation from the US perspective over here. So euro is 1.1233 US dollars worth, and Japanese yen 0.00897 US dollars per yen. Okay, too small a number, I know. And then you see the convention over here, Japanese yen. Here is a 1-to-1 division is going on. Over here, this is what? Right. So 1-to-1 division is going on, right? Anyway, and then British pound, 1.31 US dollars per pound. Swiss franc, almost an identical match, and things like that. Okay. Now the question, and this question, rosé. Okay, my daughter's favorite in Blackpink, not mine, believe me, wants to convert New Zealand dollars because she used to live in New Zealand. How do you know that? My daughter's told me about it. So New Zealand, $1 million into Hong Kong dollars. So help her, right? So how much Hong Kong dollar would it be? For that purpose, you just need to look at this table and see, over here, Hong Kong dollar and New Zealand dollar, right? And then use this number, multiply it, and then you will get there, right? That's the idea. Now, but how do they come up with this table, cross-currency tables, right? How do you come up with this? Can I do it in a homemade way? Yeah, why not? You can do it. Yeah. Here, this cross-currency table is composed of 11 countries, right? And there, right, you may wonder, is there direct, is it in FX trading desk, right? In FX trading desk, let's say one trader takes care of exchanges of two different currencies, right? Only two different currencies, because bounded rationality, like I cannot carry more than two currencies, too complicated, and I have to transact every now and then, right? Buy and sell like that. In this 11 countries present in this table, how many different possible combinations of trading is there, right? How many different numbers are there essentially, right? 55, right? 55. Why? Because we have 11 combination 2, right? 11 combination of 2. One possible different currency trading desk is needed if you want direct conversion, okay? Direct conversion. But the thing is, trading room of a bank cannot accommodate that many traders, right? Many pairs are not traded frequently, okay? Many pairs are not traded frequently. That's added problem, okay? Additional problem. So how can we make these transaction desks efficiently formed so that with minimum number of possible traders can efficiently buy and sell trades so that they can quote this if exchange rates across different countries, right? Well, the idea is let's centralize based on the most frequently traded currency, which is US dollars, right? US dollar, because it is the most liquid currency in the world, most efficiently priced. It's all about market efficiency. Whether this all information about the economic fundamental is correctly reflected in that price, whether that price is shown in US dollar terms or any other currencies with respect to US dollars, right? US dollar is frequently traded, more liquid, supposed to carry more information. Mathematicians' favorite technique is used then, like this, which is multiplying and dividing by the same number, right? And whenever people say mathematician, you may say, terribly difficult. No, okay? Don't get spooked, right? It's all about multiplying and dividing by the same number, which is US dollar, right? So let's say you want to get a spot rate, okay? Spot rate between this euro per pound, okay? How do we compute that cross-currency rate? Well, multiply and divide it by US dollar terms. Now, the thing is, here is a little bit twisted because of the convention of representing the FX rate, okay? It's more Eurocentric. Europe is the center of the world in FX market so far, right? The convention, market convention has been set in such a way that the British pound is a central unit, okay? Seems like it's a central unit. For each British pound, how much of a dollar is it? Okay, that's the common notation. And then for each British pound, how much of a euro currency is needed, right? The same denominator is happening over here. That's market convention. And then when it comes to dollar to euro relation, euro comes first because it's a Eurocentric world. And then for each unit of euro, how much of a dollar is it? That's more popularly quoted, in the market. So why don't we use this two, okay, in such a way that these two will cancel each other out, numerator and denominator, right? And then what is left is over here will be 1 over pound. What is left over there will be 1 over euro. So this is denominator, that is numerator. And what is over here goes to the denominator. What is over here goes to the numerator. So that you will end up over here, right? And then this. Oh, that's screwing up my eyes. Yeah, it's getting back to your high school math or elementary school math, right? So brush up your memories, right? That was rather complicated, I know. But when it comes to Korean won against Japanese yen, it's quite simple. It's like per US dollar Korean won FX rate, spot rate, right, by the way. And then per US dollar Japanese yen, okay? Then what happens? Well, cancel each other out. what is left is the numerator of the numerator and the numerator of the denominator. They stay the same over here. Okay? Like that. Okay? So that's how we work cross-currency rate. Okay? This part will be confusing you like awfully, but keep track of it. Okay? Don't lose thread. Don't lose the thread. Okay? 정신줄 놓지 마세요. All right? And then cross-exchange rate quotation looks like this. For example, based on exhibit 5.7, we can compute cross-FX rate of euro per pound and check with the number in exhibit 5.8. Okay, so from exhibit 5.7, which is this guy, yes, 5.7. Okay, check out those euro pound, right? Euro to dollar, right? And then dollar to pound. Get these numbers, right? Dollar to pound, dollar to euro, you get 1.3158 dollars per pound, $1.1233 per euro. Divide it, then you get 1.1714 euro per pound. All right. Equivalently, you can do it, well, pound per dollar and then euro per dollar and then divide it, right? Here, you don't need to, here it goes just straightforward, right? Anyway, so you'll find the identical answer. Based on this, you can also calculate pound per euro. Pound per euro, what is that? Well, that's the reciprocal of this guy, 1 over this guy. That should be 0.8537, right? You can also play and find the spot rate of euro per pound, euro per pound, which is spot rate of dollar per pound times euro per dollar, because it's multiplying and dividing by the same number. What you get is euro, okay, this is euro per pound. Yeah, this guy goes out there. Anyway, so that's how it works. You will get identical numbers like that. Now we move down. Check the cross FX rate between New Zealand dollars and Hong Kong dollars with the respective FX rate with the US dollar, and help Rose of Blackpink, right? That's a small quiz for your homework.